welcome to this month's episode of Fintech Firebrand. I'm Virginie O'Shea, founder of Firebrand Research, and I'm here to chat to you about this month's Fintech and finreg news. Now, one of the most interesting developments from a UK perspective this month is that the UK government has finally approved some regulation that will help in terms of boosting the country's initial public offerings and exchange businesses, hopefully. Now, the government has delivered some legislation this month to establish what is called the Private Intermittent Securities and Capital Exchange System Sandbox. Now, that's a bit of a mouthful, so it's been shortened to the acronym PICES, and it's focused on allowing stock exchanges to launch other markets for private companies that it hopes will boost growth for those companies. So this is all part of the UK's plan to become more competitive post-Brexit. It sort of mirrors some of the discussions that have been happening in the US. Paul Atkins in the SEC has already been also been talking about some interesting private capital and private markets developments too, which I'll get to later. But today's announcements mean that people can launch these new platforms in the coming months, and the plan is to have them open and available for trading in the autumn of this year. So certainly a lot of investment will need to go towards that activity from the part of financial market infrastructures, but certainly an interesting development from the perspective of smaller firms, particularly also with regards to possibly fintechs as well. Now, as mentioned, the SEC is very active at the moment with regards to making some key changes under the leadership of new chair Paul Atkins. He's obviously come before the House Financial Services Committee as well with regards to those plans, and has been answering a lot of questions about the track record of the previous SEC with the prior chair, Gary Gensler. He is stressing that the SEC has changed its tactic completely. The focus now is less on pursuing enforcement against areas such as crypto and more on fostering innovation within the market and capital formation, though he is stressing that they're not giving up on investor protection focuses as well. There's also some pressure from the government in the US to downsize the SEC, and Atkins has had to answer some interesting questions with regards to how many full-time employees and contractors are currently working for the SEC. They've indicated that there has been a reduction in staff over recent months. We've also seen the refocusing of staff. There's been a new crypto task force under the auspices of Hester Peirce launched, and she has already organised 4 different roundtables on that topic over the last couple of months. There's been a lot of industry engagement on that topic. There's also, as I mentioned, been discussion around private markets and growing those markets and looking at the regulatory regime related to those assets. So there's certainly been a lot of activity there. With regards to the Consolidated Audit Trail, or the CAT, the SEC has also made the decision to exclude personally identifiable information outside, so it's outside of the CAT now. So that's certainly very interesting too. With regards to technology, there's also been some issues with regards to data being publicly available or inadvertently being made public. Hence the moves with regards to the CAT. The Edgar system was the system in question with regards to the information being unfortunately released out between February and May this year. So certainly there's been a lot of view with regards to what happened there. Apparently, according to Atkins, it was a result of a software update that happened in February, and the masking error happened between those 2 months. So certainly there's a lot of scrutiny at the moment with regards to cybersecurity, data protection and operational resilience, as we all know. Also, that's a global issue, not just something that the Europeans are worrying about with regards to the Digital Operational Resilience Act. So expect much more discussion on that topic over the coming months. Now, nearly every regulator is focusing on crypto assets and cryptocurrencies at the moment, which is no surprise to anyone, I'm sure. So across the pond, Europe, ESMA has also issued some updates to its markets in crypto assets regulation, or MiCA as it's known, this month, or towards the start of this month, it issued new guidelines for regulators, national regulators, to help them detect and prevent market abuse under MiCA. So there's been a lot of focus on the difference between current existing markets or traditional markets and those that fall under the sort of the MiCA the banner. So certainly there are some things that firms need to think about in engaging with the regulator on this, as the regulator is very keen to get industry feedback on tweaking those guidelines and the regime itself. There's a lot of focus on these topics as part of the Savings and Investment Union and the plan to increase activity within the retail sector as well. So certainly lots of things at the European level to focus on there. We've also, something to note as well, we've also seen that securities financing transactions have been excluded from the T+1 agenda in the EU. Much the same has been agreed under the Code of Conduct in the UK. So they're on the same page, which is a sigh of relief, I believe. Operations activities for going forward will be on the same page in both regions, or both countries. So that's very helpful from a T+1 implementation standpoint. Now, my final thoughts for the month are really around planning. And I often talk about regulatory developments, and because they have such a big impact on the market, likewise does this topic of deregulation. Now, we don't expect all of the regulators in the world to agree with each other. Hopefully they will stay on the same page. We don't want to see massive divergence there, but it's something we do need to keep an eye on with regards to the rise of sort of national focuses. If we look at the US, we're seeing the Fed talking about and the Treasury Secretary talking about changes there to the Basel regime, and stepping away maybe from some of the global standards that sit under the BCBS. So this could have a significant impact if we have a downturn in the markets, and banks in the US, who are the largest, some of the largest in the world, obviously barring those in China, will potentially be very challenging if there is a market downturn, if there is massive volatility, and we do see a run on the banks and they don't have enough capital to last through it. So certainly we don't want to see a huge amount of deregulation in some areas, because it is there for a very good reason. Likewise, we don't want to see sort of massive deregulation that takes away investor protections. I understand that the goal of regulators is to become more competitive internationally, but there's also a danger of going too far the other way. So certainly that's something to bear in mind. Likewise, you don't always have to think about it from a national perspective. Global rules make things much easier from an international perspective, and most firms are operating internationally. So the fewer items of divergence, the better from a sort of operating and technology standpoint, and from a global perspective and complexity perspective overall.